Welcome to Global Trends. Please subscribe and hit the bell icon for more breaking updates. A major trade dispute has erupted between the United States and Switzerland, shaking the foundations of a relationship that has long been defined by mutual respect and economic cooperation. Switzerland, a nation renowned for its centuries-old neutrality and reputation for financial stability, suddenly finds itself at the center of a global economic storm. This time, the conflict isn't about cheese or chocolate, but about something far more valuable: gold. The Trump administration is furious over a staggering $48 billion trade deficit with Switzerland, arguing that Swiss companies are exploiting the US market and not playing fair. In response, the White House has announced record-breaking tariffs on a range of iconic Swiss imports: luxury watches, world-class pharmaceuticals, and of course, the country's famous chocolate. But the most controversial target of all is Swiss gold bars, a symbol of the nation's wealth and its role in global finance. The announcement sent shockwaves through global markets, causing investors to panic and businesses on both sides of the Atlantic to scramble for solutions. Swiss officials are pushing back, insisting that the trade deficit is artificially inflated by gold transactions, which they argue shouldn't be counted as ordinary goods in trade statistics. They point out that Switzerland primarily refines gold for other countries, adding minimal value, and say the deficit figure is misleading and unfair. As of August 29, 2025, the tariffs remain firmly in place, trade negotiations have ground to a halt, and political rhetoric on both sides is growing increasingly heated. This is no ordinary trade spat, it's a high-stakes standoff between two economic heavyweights, with billions of dollars and global financial norms on the line. The world is watching closely, wondering if these long-standing partners can find common ground and repair their suddenly strained relationship. The outcome of this dispute could set a precedent, redefining how financial assets like gold are treated in global trade agreements for years to come. For now, the golden standoff between the US and Switzerland has only just begun, and its impact may be felt far beyond their borders. On August 7, 2025, the US government made headlines by imposing a staggering 39% tariff on all Swiss imports, a move that stunned both economists and global markets. This new rate was far higher than the tariffs applied to imports from the European Union, Japan, or the United Kingdom, making Switzerland an outlier among America's major trading partners. Practically overnight, Swiss producers found themselves at a severe disadvantage in their most important export market, facing costs that threatened their competitiveness and future. The US administration justified the move by pointing to a growing trade deficit with Switzerland, arguing that it was evidence of unfair trade practices and an imbalance that needed to be corrected. Iconic Swiss products, luxury watches, precision medical instruments, and world-famous chocolate were all hit hard by the new tariffs, with prices set to soar for American consumers. For many Swiss companies, especially small and medium-sized businesses, the tariff represents an existential threat, potentially pricing them out of the lucrative US market and forcing them to consider layoffs or even closure. Perhaps the most shocking move of all, US Customs announced that gold bars, a cornerstone of Swiss exports, would also face the full 39% tariff, a decision that caught the precious metals industry off guard. Traditionally, gold is treated as a financial asset rather than a manufactured good, and is rarely subject to such high import duties, making this decision unprecedented. The Swiss precious metals sector quickly warned that the tariff would erase profits, disrupt long-standing trade relationships, and could halt gold exports to the US entirely. Overnight, a major artery of the global gold trade was effectively shut down, with shipments halted and vaults left empty, sending ripples through international markets. Traders and investors around the world were left reeling, scrambling to assess the impact and adjust their strategies in the face of sudden uncertainty. The decision sent shockwaves through the world's financial system, triggering volatility in markets and raising questions about the future of global trade. The gold market, once stable and predictable, would never be the same after this historic move. The $48 billion US-Swiss trade deficit was the spark for Trump's tariffs. But Swiss officials and economists say the number is misleading, because it includes gold. Switzerland refines much of the world's gold, but adds only a tiny fraction of value. In early 2025, $36 billion of Swiss exports to the US were gold. Remove gold, and the deficit shrinks dramatically. The Swiss argue they're providing a service, refining gold, not exporting a traditional product. The real profit for Switzerland is just a few $100 million, not billions. Counting the full value of gold as a Swiss export, they say, is an accounting fiction. Gold moves globally for investment, not consumption. Including it in trade stats creates a politically explosive but misleading number. The US government's calculation paved the way for a conflict based on a flawed premise. The gold debate is at the heart of the standoff. The numbers tell two very different stories. Switzerland insists gold is a financial asset, not a typical export. Gold acts like a currency, held by central banks and investors as a store of value. Swiss refineries process 2/3 of the world's gold, but only add a small service fee. When refined gold is shipped to the US, it's counted as a massive Swiss export, even though the real value added is minimal. Swiss officials argue only the refining service should count toward trade figures. Many global experts agree. Gold is a monetary asset, not a consumer good. Taxing gold bars like watches or cheese, they say, ignores economic reality. The US approach treats a global financial instrument as a manufactured product. This misunderstanding is fueling the trade dispute. The gold tariff is a clash of economic definitions. The 39% tariff on Swiss gold bars sent shockwaves through global markets. Gold prices in the US soared above global benchmarks, creating chaos for traders and investors. Arbitrage between London and New York became nearly impossible. US jewelers and manufacturers faced skyrocketing costs for a crucial raw material. Swiss companies struggled, some absorbed losses, others passed costs to American consumers. US businesses relying on Swiss components faced supply chain disruptions. The Swiss stock market tumbled, especially for luxury and pharmaceutical firms. Business leaders warned the tariffs would damage both economies and the long-term partnership. The move was seen as politically motivated, not economically sound. Instability and uncertainty spread on both sides of the Atlantic. The gold tariffs' ripple effects were immediate and severe. Before the tariffs, Swiss President Karin Keller-Sutter traveled to Washington, hoping to defuse the crisis. Switzerland offered a $150 billion investment package and had already dropped tariffs on most US goods. But the diplomatic mission failed. President Trump refused to meet, and US negotiators rejected compromise. The White House insisted only dramatic action would fix the deficit. After the tariffs, confusion reigned. Officials hinted gold might be exempt, then reversed course. Businesses and traders were left in limbo, unsure of the rules. The official customs ruling stayed in place, and gold shipments faced the full tariff. The lack of clear communication deepened the crisis. Decision-making stalled as uncertainty spread. The standoff became a symbol of diplomatic dysfunction. In Switzerland, calls for retaliation grew louder, echoing through the streets and the halls of government. Public anger simmered as many Swiss citizens demanded a strong response to what they saw as unfair US trade measures. Swatch CEO Nick Hayek stepped into the spotlight, proposing a bold 39% export tax on gold bars bound for the US. His aim was clear: to strike back at the American financial sector and send a message that Switzerland would not be pushed around. But the Swiss precious metals industry quickly warned that such a move could backfire, potentially damaging Switzerland's hard-earned reputation as a stable and reliable financial hub. Business leaders feared that investors might look elsewhere, and that Switzerland's global standing could suffer. The government, caught between public pressure and economic caution, chose to stay silent for now, preferring diplomacy over escalation, and hoping for a peaceful resolution. Meanwhile, the US tariffs remained firmly in effect, including the controversial gold duty, leaving both sides at an impasse. Economic pain mounted for Swiss exporters, who faced shrinking markets and rising costs. US consumers too began to feel the pinch as prices rose and certain goods became harder to find. The global gold market stayed volatile, with traders on edge and trust in international agreements eroding. Financial stability, once taken for granted, now seemed increasingly fragile. The once strong US-Swiss relationship was now deeply strained, with both sides wary of the next move. The dispute quickly became a symbol of rising global trade tensions, as other nations watched closely and considered their own positions. It showed just how quickly economic norms can be upended by political decisions, and how fragile the global trading system truly is. The world watches and waits. Will cooler heads and diplomacy prevail? Or will the golden standoff spiral into a full-blown trade war with consequences far beyond Switzerland and the US? The precedent set here could reshape how nations treat financial assets and each other. The clock is ticking, and the world holds its breath for what comes next.